All right. Wednesday, January 28th, 2026. The closing bell just rang, and we're looking at the final print. S&P 500, it finished up 0.15%.
Barely.
Barely. The Nasdaq Composite added, what, 0.25%? And the Dow Jones actually dipped minus 0.10%.
And, if you just glanced at your phone, you'd think, quiet day. But you would be dead wrong.
Deceptively calm is the phrase of the hour, isn't it? We're looking at the bulls, bears, and the bell briefing, and it suggests today wasn't quiet. It was more like a knife fight in a phone booth.
It was a standoff, a high-stakes, high-volume standoff. I mean, you have to look past the headline numbers immediately because the context here is everything. We're sort of sitting in the eye of the storm.
Right. We've got the Federal Reserve decision that just dropped. We have this massive triple bill of big tech earnings coming up, and the market is just, it's paralyzed. The source material calls it a choppy mess.
Paralyzed is the right word. But it's not paralyzed because of a lack of effort. It's paralyzed by sheer tension. The market's waiting for a signal, and honestly, today it just got a lot of noise, not the green light it was desperate for.
So our mission on this deep dive is to unpack this. We need to take these institutional grade notes and translate them into a battle plan for tomorrow morning. Because if you're just looking at that 0.15% gain, you are flying blind.
You're looking at the scoreboard, not the game. And the game today was brutal.
Let's start with the catalyst then, the big event. Chair Powell and the Fed. We knew they weren't cutting rates today. I mean, that was already priced in. But Powell held rates at 3.75%, and the reaction wasn't exactly a celebration.
No, the hold at 3.75% was totally expected. The surprise, and the reason that we saw this weird grinding price action, is what the analysts are calling a hawkish hold.
Hawkish hold. It sounds like a wrestling move. Let's unpack that for a minute.
So typically, if the Fed holds, the market immediately starts betting on when the cut is coming. A dove wants cuts now, a hawk wants to keep rates high.
Right, and the market was pricing in, what, March? Maybe May?
Exactly. But Powell came out and he essentially kicked the can down the road. He pushed the projection for the first cut all the way to July.
July, that's a massive shift. I mean, that's half the year gone before any relief.
And that is the hawkish part. He's saying, look, we aren't raising rates, so don't panic, but we are absolutely not coming to the rescue anytime soon. He basically removed the safety net for the first half of the year.
And that tonal shift explains the weird energy this afternoon, which, brings us to this idea of churn. The notes keep mentioning that word.
Churn is the defining characteristic of today. Absolutely.
I want to highlight the volume numbers because they are, frankly, staggering. Total exchange volume was 11.4 billion shares. That's 14% above the average.
That is a massive amount of paper changing hands. A huge amount.
But, and this is where it gets really interesting, despite all that activity, the S&P finished within 0.08% of its opening price.
I mean, think about the physics of that. Billions of shares, billions of dollars, and the price went nowhere.
It's like a car stuck in the mud. You can slam on the gas, the engine screams, the wheels are spinning like crazy. That's the volume. But the car isn't moving.
That's a perfect analogy for churn. Or picture a tug of war. You have the bulls on one side, veins popping. You have the bears on the other, digging their heels in. Both sides are giving it everything they have. But the rope, it's not moving. It looks static, but the tension is explosive.
It's not relaxation, it's exhaustion. So here's the million-dollar question. Who's doing all this trading? The notes specifically point to institutional behavior.
And this is the key takeaway. The big money, the pension funds, the whales, they used the liquidity from that 2:30 p.m. press conference to reposition, not to commit. They faded the rally.
Faded the rally. Let's break down the mechanics of that because a lot of retail traders get caught in this exact trap.
It's the classic trap. So the Fed statement drops at 2:00 p.m. The headline says, no rate hike. The Algos see that, and they buy instantly. The Nasdaq spikes.
The knee-jerk reaction, the retail pop.
Exactly. But by 3:15 p.m., when Powell's talking about inflation still being an antagonist and mentioning July, the institutions step in. But they don't sell into a falling market. They sell into that spike.
Because they need the liquidity to get out.
Precisely. If you have $1 billion of stock to dump, you can't just hit sell. You'll crash the price against yourself. You need a wall of enthusiastic buyers to sell into. That 2:00 p.m. pop gave them that wall. They used the optimism to offload risk.
So they were handing the heavy bags to the people chasing the headline.
Ruthless but efficient. The notes say they weren't panicking, not exiting entirely, but they were de-risking, taking chips off the table ahead of the next jobs report. They just are not willing to bet the farm right now.
Which explains why we're stuck. We keep bumping our heads against that ceiling, and we just can't punch through it.
Well, you can't break a major resistance level when your biggest players are using every little uptick as an exit. It's just simple supply and demand.
Speaking of supply and demand, let's look under the hood. The scoreboard says the S&P was green, but the internals section here tells a much darker story. They're calling it a K-shaped market.
This is the thin ice thesis. To see the market's true health, you have to look at market breadth. Today, the advanced decline ratio was 0.8 to 1.
So simply put,
It means for every 4 stocks that went up today, 5 went down, even though the index itself was green.
that feels like a contradiction. How can the index be up if most stocks are down?
Because the S&P 500 is market cap weighted. It's an aristocracy, not a democracy, you know. The giants, the sovereign AI basket, as the notes call them, they did all the heavy lifting. NVIDIA, Microsoft, the trillion-dollar club. But the engine room of the economy, mid-caps, small-caps, the Russell 2000, they all finished deep in the red.
So the generals are marching up the hill, but the troops are retreating.
That's exactly it. And that is a dangerous setup. A healthy rally needs broad participation. Today, the market was basically standing on a toothpick. If that one mega-cap toothpick snaps, the whole thing comes crashing down.
The notes highlight some specific outside day patterns that show this rotation. They call it the tech fade versus the safety snapback. Let's start with the tech fade.
Yeah, this was fascinating price action. Look at NVIDIA and Microsoft. Both of them gapped up this morning, opened with like 1% gains, total optimism. But where did they close?
Near their session lows.
Near their lows. They opened high, trapped the buyers, and then just bled out all day. That signals distribution. It means the whales were using the morning pop to dump in stock. They are treating tech like an ATM right now.
Okay, so they're taking cash out of the tech ATM. Where are they putting it?
They're putting it into the safety snapback. Look at consumer staples, XLP, utilities, XLU. I mean, these are the boring stocks. Toothpaste, electricity.
Yeah, not exactly the exciting stuff.
Not at all. And this morning, they opened in the red because everyone was chasing AI. But by the close, they reversed and closed right at their highs.
So capital's rotating, hiding in plain sight.
It is. Investors are rotating from growth and risk into safety and dividends. That is a defensive crouch. You don't buy utilities if you think the economy is about to rocket to the moon. You buy them if you think a storm's coming and you want to keep the lights on.
Speaking of storms, let's talk about the VIX, the volatility index.
The fear gauge.
Right. So the VIX dropped to 13.2 today, down 4%. Usually a low VIX means clear skies, low fear. Right.
Usually, yes. But the notes are calling this the volatility paradox or the VIX trap.
Why is it a trap? I mean, if fear is down, isn't that good?
It's a trap because of what the VIX actually measures. It measures the cost of options for the next 30 days. The immediate event, the Fed is now over, so that event risk premium came out. But there's another metric. It's called the VVIX.
The volatility of volatility.
Yeah, it's a bit of a tongue twister. But think of VVIX as the demand for volatility insurance. While the VIX dropped today, the VVIX actually ticked a little higher.
Okay, so what does that divergence tell us?
Imagine you live in a hurricane zone. The VIX is today's weather report. Sunny skies, light breeze. But the VVIX is the line of people at Home Depot buying plywood for their windows.
So even though it's sunny, everyone is boarding up.
Exactly. The smart money isn't buying protection for today. They know today is over. They're buying tail risk protection for the future, specifically for that February 4th Fed meeting and for earnings.
Ah, I see. So the VIX dropping isn't a sign that everything's okay.
Not at all. It's the calm before the storm. The notes explicitly say hedgers are loading up on disaster insurance for next week. It's a very deceptive signal. If you just look at the VIX, you get complacent. If you look at the VVIX, you get prepared.
Deceptive is the theme of the day. A green scoreboard with red internals. A low VIX with rising tail risks.
It's a market in conflict with itself. It doesn't know what it wants to be yet.
So knowing all this, what do we do tomorrow? The head of global strategy included a section called the setup for tomorrow. And I want to get granular here.
This is the actionable part. Let's talk execution.
Let's talk about the gamma wall. The notes mention a critical level at 5,950 on the SPX.
5,950. Yeah. If you have a sticky note on your monitor, write that number down. That is the line in the sand for tomorrow.
For anyone who doesn't know, can you define gamma wall simply?
Yeah, sure. Simply put, think of it as a magnetic force field created by the options market. At 5,950, there's a huge concentration of options contracts. And the market makers, the banks, they are basically forced to act at this level to hedge their books.
So they're algorithmic robots at that point. They don't have a choice.
They don't. So if the price stays above 5,950, the market makers are buying the dips to stay neutral.
It acts like a floor. It kind of holds the market up.
Exactly. It stabilizes things. But if it breaks,
If we crack 5,950 with volume,
if 5,950 with volume,
if 5,950 breaks, the magnet flips. It starts pulling us down. It triggers what they call a delta flush. Market makers have to sell futures, which drives the price down, which forces them to sell more.
a feedback loop.
A rapid waterfall of selling all the way down to the next support level, which is 5,880. So tomorrow morning, we're all staring at 5,950. If it holds, we breathe. If it cracks, look out below.
Precisely. And looking at the probabilities, the strategy team is cautious. They calculate the trend continuation probability at only 22%.
Wow, only 22%? That seems incredibly low.
It is. But remember, today was a doji day, a day of indecision. And historically, after a neutral, high-volume day like this, the chance of a strong trend day right after is low. The market is just tired.
So don't chase the morning move.
No. The advice is to expect a two-sided morning. It'll probably go up, then down. If you jump in at 9:35 a.m. thinking this is it, you're likely to get chopped up. Patience is the edge.
The notes do offer some specific tickers to watch, though. Let's look at the king again, NVIDIA.
NVDA. You can't ignore it. The notes suggest looking for a high-tight flag pattern.
A high-tight flag. Break that down.
That's a bullish consolidation pattern. The stock shot up. That's the flagpole. Now it's just drifting sideways, very tight, refusing to give back its gains. It's just hovering.
Catching its breath, but not retreating.
Right. And the fact it isn't selling off shows that there's underlying demand. The strategy is simple. Entry if and only if it breaks Wednesday's high.
Why is Wednesday's high the trigger? Why not just buy it now?
Because institutions were restacking at that high. They were selling there today. If the price breaks above that level, it proves the sellers are exhausted and the buyers are back in charge. You want the market to prove it to you first.
Got it. Let the market tip its hand. What about Palantir? PLTR. That one has been hot lately.
Palantir's different. It just broke out of a base. The play here is what we call a red to green move.
I love a good red to green. Explain how that works.
So you actually want the stock to open a little bit lower tomorrow. That's the red, maybe down 1%. This shakes out the weak hands, the nervous people.
They have your hands.
Exactly. You want them out.
Yeah.
Then, if and only if it rallies back and reclaims the opening price, turning green on the day, that's your buy signal.
Because it shows resilience. Buyers are stepping up to defend the level.
Precisely. It confirms the breakout is real and that the FOMO wave is kicking in for day 2.
And finally, there's one asymmetric trade for the broad market. Long SPY or QQQ. But with a condition.
A big condition. Only if Wednesday's high is reclaimed early in the session.
And why is that the trigger?
It's a volatility squeeze. The idea is that all the short-term hedges people bought for the Fed, those puts are expiring. If the market starts moving up past yesterday's high, those hedges have to unwind.
Which creates buying pressure.
Huge buying pressure. It can create a relief rip, like a coiled spring releasing. But again, you need that confirmation. Reclaim the high.
Right.
Otherwise, you're just guessing in the mud.
So let's zoom out. Putting it all together, what does this all mean for tomorrow morning?
It means we are in a standoff. The bulls couldn't push higher. The bears couldn't break the market down. Everyone is just staring at everyone else across the poker table.
It feels like everyone is holding their breath.
They are. But they won't be for long. That's the hook for tomorrow.
Right. The calendar. The Fed was today, but Apple reports earnings tomorrow after the bell. That's the big one.
The biggest. I mean, Apple is a market unto itself. If Apple misses or their guidance is soft, it doesn't matter what the Fed said. The market will react.
And don't forget the morning. 8:30 a.m., core PCE inflation.
That's the Fed's favorite number.
It is. And remember what Powell said about July. If that PCE number comes in hot tomorrow, that July rate cut might get pushed even further back.
And if that happens, that 5,950 gamma wall we talked about, it's going to be tested immediately. Violently. So the volatility isn't gone. It's just sleeping.
Sleeping with one eye open. Before we sign off, I want to leave our listeners with one final thought. We talked about the scoreboard versus the game.
Yeah. The idea of hidden distribution is the most important takeaway here. It's so easy to look at the S&P hitting a new high and think, everything's great, my 401k is fine.
But that's just the scoreboard.
It's just the average. If you look at the game itself, the individual stocks, the breadth, the team is getting tired, the engine room is failing, the generals are leading, but the soldiers are retreating. So my question for you is this. Are you investing in the index or are you investing the market? Because right now, those are two very different things.
That's a great perspective. Don't let the green numbers fool you. Check the engine.
Always check the engine.
Stay nimble out there, everyone. Watch that 5,950 level tomorrow morning. We'll be watching it with you. Thanks for listening to this deep dive.
Take care.